From the hills of West Virginia to the high rises of Chicago. For over 30 years, Dan Frio has mastered the real estate market as one of the country's premier mortgage advisors. Dan is now sharing his experience and knowledge with the AM 560 audience. So sit back and learn how Dan has helped his clients manage the ups and downs of the real estate market across the country. Now, here's the host of the Mortgage Update, Dan Frio.
Welcome to the Mortgage Update with Dan Frio, and I, of course, am Dan Frio. Top of the morning to you. Today we have later in the show, and part of the beginning of the show, we have two special guests of mine. One, you know, Stevie G. Life coaching with Stevie G. Stevie's in the studio with us today. He's going to be partaking basically the whole show with us today. But then we're going to do a segment that'll be on the show, and that'll be also podcasted and YouTubed of Life Coaching with Stevie G. We're going to talk about fear today, and we all have fear in some part of our life. It might be at work. It might be just anxieties, I guess, is the best way to put it. So that's what we're going to talk about with Stevie G on that episode portion of today's show. Also, I have Jason Nobles here with me. He is on the Frio team, and he is the FHA guru. When somebody calls in, just so you know, if you call in, we pride ourselves that when you call in, it's personal. Most of the time you do talk to me, probably 99% of the time. But if I'm not there, if I'm at the radio or with a client, it'll go to Jason or one of the other team members because, you know, basically we want to make sure your answers or your questions are answered right then and there. But they still come to me with these applications. And mostly, you know, in most cases, I'm going to be the one calling you back and going through what we figured out and the best program for you. So welcome, guys.
Hi. Good morning.
So here's what I want to start the show with. I want to start right now with all the stuff going on in the Middle East. And the reason being is, you know, I always say about this show, when I started the show, I wanted to make it pertinent to somebody listening, not a generic stroke of, okay, the Dow's up 4. If you don't have any money in the stock market, do you really care that the Dow's up whatever? What's happening right now, though, is I predicted, if you follow me on YouTube, with the bombings in Iran, and you can go back to the beginning of the week, is if you think of the uncertainties in the world, you're probably most likely thinking that a couple things are going to happen. The stock market's going to drop, which that's, you know, we have issues of that in the past, and that's proven when there's uncertainty in the world, such as the bombings and such as the threats. Usually the stock market plummets. And then people take that money from out of the stock markets and they put it in the bond market, thus pushing down interest rates. So this week we didn't see that, which is weird. And so I don't know if somebody knows something I don't know, but that's just weird. So right now what I did is, you know, interest rates actually jumped up during the week. So if you're a realtor out there, you're a mortgage loan officer, you're a mortgage advisor, you're a home buyer, or you're looking to refinance, rates went up. So if you got a quote prior to, you know, be careful of that. So Jay, let's start on with us. Just do a little intro, who you are, what you do for the team and all that. And just basically, who are you? And when they call you, they can get a feel for, okay, that's Jason.
Definitely. I'm Jason Nobles, mortgage loan officer. I work with the Frio team, and we've been kicking butt. I handle a lot of the FHA loans that do come in. So borrowers that come in and are looking for financing and don't necessarily meet the guidelines of a conventional borrower, we'll go over the FHA guidelines and to see if that's something that we can make happen for them.
Cool. So what we're going to do in the second segment, so don't go away, guys, is we're going to talk specifics.
Okay.
You know, because the FHA has a bad stigma.
Sure.
Soon as a lot of times, I don't know if you probably have it happen. People call and I'm like, you know, most likely we're going to look at the FHA program. Oh, I don't want FHA loan. Yeah. I don't want that kind of loan.
Yeah.
And we're going to talk about
there's nothing wrong with it.
There's nothing wrong with it.
Get you in the house.
I mean, many times it's going to, and you'll elaborate on this, it might get you into the house with a lower rate, lower down payment. You know, there's a whole bunch of pieces of that puzzle. Yep. And then we all know the man, the legend, Stevie G.
Yeah.
What's up,
baby.
Steve? Happy 2020, Buster.
Yeah.
I see him every day, but usually it's kind of in passing because he'll have somebody in his office. Yeah. They're doing training. Tell him again what you do for the team. Yeah. And Steve is a great guy. He actually coordinates a lot of our realtor partnerships. And he does, if you deal with the Frio team, he's on the team and he will train any realtor I'll pick up the cost. I promise you. So if you're a realtor out there and you want to take your business to the next level in 2020, give us a call. We all need coaching. So that's all I can say. I go to Jason every day probably and have FHA questions. There's other people that you're going to meet on our team in the upcoming weeks because every week we're going to have, it's either going to be Tuesdays or Thursdays, we're going to have a member of the team and they're going to talk about specifically what they specialize in, be it FHA, jumbo, reverses, any kind of USDA, any kind of mortgage programs. But Stevie G's the man. He's our trainer. He also trains loan officers. But his big role is to train realtors because the better you are and the more sales you have and the more people we put into homes, hopefully you reciprocate and we get that business and help you partner to get these people into homes. Welcome, Steve.
Yeah.
Tell them about you.
Hey, Dan,
we had you on one show prior to, and now you're going to be a weekly guest on Wednesdays Life Coaching with Stevie G.
Yeah, well, I just want to say I'm very honored today because Mr. Jay Nobles is with us.
The man.
So,
I'm looking forward to it.
Yeah.
I feel like I kind of screwed up, though, and I didn't really tell you much about myself.
Yeah. We'll get into it. By the end of the show, they'll get to know you. And you're going to be on probably every 2, 3, 4 weeks.
Perfect.
Just talking about, what happened. We're going to talk about clients who called in and said, I don't want FHA, but how it benefited them more than any other program that we have.
Yeah, absolutely.
So, Steve, what do you do when you coach? I guess let's start with that real quick.
It was kind of funny on Good Morning America or the Today Show. Yeah. They were talking about people making transitions in their life between 55 and 65 years old. And the one woman said, well, I became a coach because I wanted to share my experiences with people.
That's a good idea.
And to help them. Yeah. It's kind of where I'm at, right? 58, 30 years in the real estate industry, from real estate to mortgages, been in the boxing business, been in the moving business, restaurants. So I'm going to share with you my ups and downs. Been rich twice, been broke twice.
You're a jack of all shades.
That's what I want the show to be about because even Jason and I were talking yesterday about, and we'll reiterate this a little bit, a lot of times we place somebody with an FHA loan because of their credit scores. Yeah. Dude, my credit scores aren't in the 800s. No. And I even kind of coach people through credit repair and credit, hacks and all this other stuff to get credit scores up there. But you might have some blips in the radar, and we'll go over this in the next segment. That's there that you just, you can't get around it. So let's focus right now. Here's what's you guys' take on, for whatever you have, on the Iran situation. What do you know about it? And, what do you think is going to happen in the next couple days, the next week or two? Any input?
Honestly, I think that with every cause, there's an effect. So, we see us bomb, they bomb. Us bomb. It's just kind of like anything in life. You hit me, I hit you back. Yeah,
I was surprised when Trump came back and said, you know what? We're just going to jack up not the tariffs.
Economic sanctions.
Yeah, the sanctions. He put sanctions on them, and he tightened the screws on that, and that'll help. But situations. But I think it shocked the market because what should have happened is everything should have plummeted.
Yeah, typically.
And then you see the stock market go up 200 points the day of the bombing. It's like, what? So, that's one piece of the economy.
Is it bad that we as mortgage loan officers see war and we say to ourselves, man, the rates are going to come down, and we start rubbing my hands together?
I have a tendency, I post every day on YouTube.
Yep.
So those are out there that are watching everything. All these shows are on YouTube. They're on podcasts, and they're on, basically everything else. I'm always reluctant to say, kind of like you just said, great, we just bombed somebody or somebody just bombed us. And I hate to say it that way.
But hey, Dan, don't we do
the
good?
Uncertainties.
So the real estate industry does good, or the mortgage industry, whether rates are low or right?
Absolutely.
Yeah. So,
absolutely.
People make money in the stock market. They want to do something with it.
Yeah.
So we're really in a win-win situation, in my opinion.
Yeah.
But the nice thing is as rates keep going lower and lower and lower, like I don't know how many refinances we do a month, and we save people $200, $300, $400 a month,
helps everybody,
and pay off some bills.
I get 3, 4, 5 calls a day at least.
It's crazy. crazy. So, if you hear us cheering about, the Iran situation or whatever, please don't take offense to it. We're not, I don't want the country to be at war. I don't want our men and women to be in harm's way. I don't want any deaths anywhere. No. But on our side of the equation, it's, here's the best way for me to describe the markets. Okay. You have X amount of money to invest. Okay. There's two buckets you can invest in. One is the stock market and one is the bond market. And part of the bond market is what they call mortgage-backed securities. Those actually create the bonds, or those are the bonds that actually determine mortgage rates. So if the economy is booming, 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 what are you doing? Well, your bond yields are about 2-3%, say. Your stock market, I think the S&P 500, I saw a study of this. It was up over 20-25% last year. Mm-hmm. So do you invest in the stock market and get your 20% returns? And that's not typical, but right now. Or do you buy a bond at 2%? Obviously, if the economy is going good and everything's cranking and there's euphoria in the markets, you're going to put money in the bucket of the stock market. So, thus, you're pulling money out of the bond market. You have those two instruments to pay to do your investments. So, as you pull money out of the bond market, you're bringing down the prices of the bonds because they're trying to attract more people. As the price of the bonds go down, the interest rates go up. Okay, so what happens though is you have uncertainties in the market. You have Iran bomb us. You have other things, Brexit, all this other stuff. The tariff wars with China that creates uncertainty in the stock market. So people are like, you know what? I don't want to lose money. I'd rather get my 1, 2, 3, 4% yield in bonds. So I pull money out of the stock market and I start buying the bond markets. Right. Thus, raising the prices of the bonds because there's only so many bonds. As you buy it and the demand goes up, the prices go up. Thus, inversely, interest rates or those yields go down. So as money pumps into the bond market, yields are coming down. Thus, mortgage rates are coming down. So with the uncertainties in the market, that's what I'm trying to explain with the bombing and the tariff wars and the China situation, and the Brexit stuff. There's uncertainty in the world, and especially as we saw this week with the bombing in Iraq. You're thinking, well, everybody's going to dump out of stocks, put all that money into bonds, thus making the stock market go down, bond prices go up, and yields and mortgage yields come down. So don't go away. When we come back, we're going to talk to Jason further in detail on what FHA is and the misconceptions of FHA. So don't go away. Even if you don't need an FHA loan, you might know somebody you can give them some advice on. So don't go away. We'll be right back.
Now, more of the Mortgage Update on AM 560. Here's your host, Dan Frio.
Flash alerts! FHA loans aren't bad, and they're not for people that have junk credit. So, welcome back to the Mortgage Update. I am Dan Frio. I am here with two friends of mine, and they're on the Frio team, Jason Noble and Stevie G.
What's up, Danny boy?
How we doing?
So, FHA loans. I get this a lot. Somebody will call and say, I don't know if I can get a pre-approved for a loan, but we typically have somebody looking to buy. Right. They want to go with the lowest down payment.
Always.
Many people are strapped in their budgeting, and we in the business call it a debt ratio. Right. And we'll explain that here in a minute. But Jay, tell us, I guess just generically at first, what is an FHA loan basically? And then let's go down the path of why would you place somebody FHA versus a conventional loan or whatever. So again, don't turn the dial because this information might not affect you today, but it might affect you down the road and or your kids, your nephews, aunt, uncle, coworkers. If you can provide any information to them, educational information, that's what the whole show's about. You know, what's in it for you and those in your sphere. So go ahead, Jay.
So an FHA loan, what it basically is it's a loan that is backed by the federal government. And what they allow you to do is to, in certain scenarios, you can do a lot less down, like you just touched on. A lot of times I'll deal with borrowers who have not bad credit, but just not so great credit, you know. So we might have to look at a two-step process is how I sell it. I'll sell them an FHA loan with the idea that we're obviously going to do this for a short term, and then we'll go into a conventional loan once you qualify at that point in time. There's a few different details that go into FHA and whether or not somebody is a borrower that would be or we consider a FHA borrower. The scores, I mean, a lot of times you'll see borrowers, I'll talk to people every day and they're like, oh, well, I don't think my credit qualifies me for an FHA loan, or I don't know if I
for any
loan, to be honest with you. Yeah. And so I'll look at the whole scenario, and, typically what I'll see is, borrowers, they do have a couple bucks and they want to just try to get into the home. So that's what I try to sell is like, this is an idea. This is what's going to get you into the home. Now, FHA loans, one thing that separates them from anything else is that they do have mortgage insurance. An FHA loan with mortgage insurance, basically what that means is you're paying in addition to your mortgage payment, you're paying an additional premium that would basically, what's the best term I can use for it? Insure your loan.
Yeah, insure. So what an FHA loan does, the government actually backs your loan. It's the biggest benefit, honestly, is to the lenders, us.
Right.
It insures us of default. So, if you don't put down 20% on any loan, you have what's called PMI.
Right.
So what's the minimum credit score for an FHA loan, and then the minimum credit score for a conventional loan?
580 minimum credit score on an FHA loan, 620 unconventional. So
got it. So many times what we do is, even if you have a 620 credit score and you can qualify for a conventional loan, the rate's terrible.
Right.
I mean, it's terrible.
It's horrible.
So we can go with an FHA loan and pick up the pieces there and get you a much lower rate.
Right.
So when they underwrite it, they look at somebody with a loan. Why do you will go to them because it's better underwriting standards? Is it harder to go conventional than it is FHA?
No. Well, you can answer.
It's not necessarily harder to go conventional. There are obviously requirements for conventional that a lot of borrowers that are going FHA don't qualify for. For instance, credit scores, like we just covered. An FHA borrower that's got a 580 score, typically they're going to think that they're out of the box. Whereas, obviously they're not a 620, but we can get them in the home with that 580 score. Minimum money down.
So the FICO scores, you only have to be at a 580?
Yeah.
Correct.
And here's why. I won't say they're loose guidelines like subprime used to be, and everybody's like, oh, man, those standards are back again. The economy is going to crash. You're paying, the government actually is subsidizing a lot of this to ensure that mortgage, so in case it defaults. Okay, so if the mortgage defaults, the HUD comes in and basically makes the lender whole. Okay. And this might be a whole nother show on when the crash happened. The banks weren't as hard off as you think on mortgages. So that's a whole nother area. So down payment.
Yes.
Your down payment in many cases is lower.
A lot less. 3.5% down payment on FHA. And I can go into this. There's a couple of different ways, Dan. We can go into this a couple of different ways with regards to conventional. I mean, you've got 3% down, you've got 5% down. Right. It all depends upon what you qualified for. But yeah, FHA typically 3.5% down.
But the cool thing is too, in FHA, it can be a 1, 2, 3, 4 unit.
Oh yeah, absolutely.
As you move up that chart on conventional, it's more and more and more money that you need as a down payment.
Right.
So here's the area that I see a lot. I'll have somebody call me and they're like, I had a bankruptcy a couple years ago, but my credit score is phenomenal.
Right.
Many times I don't get that part of it. And you've been doing this long enough. The credit scoring system is really weird.
Yeah, it is.
But most of the time we place somebody in FHA is they either had a bankruptcy or a foreclosure.
Yep.
What's the difference in the time durations of the FHA programs versus the conventional programs?
So for FHA, anyone that's had a bankruptcy Chapter 7, it's typically a 2-year from the discharge date, whereas with conventional, you're looking at 4 years. So that in and of itself is obviously a big difference. In regards to the foreclosures, you're looking at about 3. You're looking at exactly 3 years. Excuse me.
Okay.
For FHA. Whereas you look at 7 years on a conventional loan. So
I don't know, but you look around the table here and we have a pretty big sphere of influence in family and friends and who we know.
Yes.
How many people do you guys know that, not fault of their own, but they went through a bankruptcy, in the last 10 years?
Stuff happens.
A lot.
Yep.
A lot of people. So, again, we don't want to say the FHA program is for those that are just deadbeats.
No, it's not.
That's
the case
not
whatsoever.
the case.
No,
there's a lot of things that you have to meet to get into an FHA program. Here's one thing, and this is an area that a lot of people start to say, well, you're getting back into those stupid loans or stupid underwriting. the debt ratios.
Yeah.
Explain what a debt ratio is and how high can you go in conventional and still get approved? And then how high can you go on an FHA loan and get approved? And again, remember, these are government backed. The government's they're not trying to put bad people into the housing market to have the housing market crash. Right. They're trying to help. And they really are. So debt ratios, explain what a debt ratio is.
So a debt ratio basically is, now I can go into a whole spiel on ratios and things of that nature. So I'm going to give you the Cliff's Notes version of what that means. So what you're looking at with your debt ratios is it's your total debts plus your proposed mortgage payment divided by your total gross income. And what gross is that's your total income that you're receiving before your check is written. So you'll see your gross income, say it's $2,000, subtract out whatever your taxes are and whatnot, and that's what your net check is going to be, which is what you would then deposit into your bank. People always have that question.
A lot of times when we're talking, and I know you do this, a lot of times when you're talking to somebody, they'll forget to tell you some debt.
Yes.
Here's what here's probably the best way to find out all the debts that you have, just so you're not missing anything, because you might think of, I didn't think of that. That could have a big effect on your especially if you're getting pre-approved to buy a home.
Yes.
Go to creditscoresandmore.com. It's plural. Creditscoresandmore.com. It's a website I created. And the reason why I created it is exactly this. Is to help people with their credit. Because if Jason and I can't help you buy a house, probably two reasons. One, you don't have the income to support a house payment. Or two, you don't have the credit. So I can't help you with the income. I can help you with the credit. So go to creditscoresandmore.com. But that was a great explanation. So we take that, all your debts, divided by your gross monthly income, and that's before the government and the state takes away from you.
Right.
You divide those out. What ratio can you go on a conventional loan versus an FHA loan?
50% conventional and 55% FHA.
Got it. So that's why in many times, if somebody's debt ratio is 52, 3, 4, you cannot get a conventional loan.
Right.
So we're automatically going to take you to an FHA loan. Again, we're not saying that that's a bad loan. It's a loan that can very much help you.
Right.
So if you could, what is kind of the perfect picture of who is an FHA candidate?
Anybody, honestly. I don't want to paint a picture and put them in a box, because that's not the case. Anybody can get an FHA loan. Anybody can. There's no specific type of person that qualifies for an FHA loan. There's no specific class of person that qualifies for an FHA loan. It's all based upon, like, the things we were just discussing. Obviously, your credit scores, the amount of money that you have to put down, prior credit history, whether or not you had a bankruptcy or foreclosure in your past, and things of that nature. You don't allow that stuff to beat you up. I mean, you still want to finance yourself and get out of a place where you're renting for $2,000 a month or whatever the case may be. Give us a call and we'll be more than happy to see what we can do.
And that's why we're still old school.
Yeah.
I highly suggest, even when somebody applies online, you know this.
100%.
We both get those leads.
Yep.
And one of us is on the phone or trying to get you on the phone immediately. I hate the online systems because you don't know what you don't know.
Right.
And that's what we do. That's why I consider us your mortgage advisor, not just a loan officer. I don't want you going online and just going plugging in your stuff, getting a pre-approval in 30 seconds, and then trying to take that to the bank. I can guarantee you're probably going to run into some issues there.
100%.
So when we come back, we're going to have this week's episode of Life Coaching with Stevie G. And today what I want to talk to Steve about is fear. I still have fears of sales in the mortgage business, and I've done this over 31 years. So don't go away. We're going to be back with Stevie G.